All right, you guys can see my screen when I have the presentation up, right? I'm only asking because I'm only working with one screen, so I'm gonna have to go from tab to tab. So I just want to make sure that you guys can all see that when I switch over to Google Slides. I bet. Sounds good. All right, cool. So, hey everyone, my name is Samuel Deane, and I am a financial advisor. I'm the CEO and founder of my firm, Deane Wealth Management, and we work exclusively with millennials in tech. So all of my clients either are startup founders or early employees at certain tech companies, or even a few of my clients work at more mature tech companies like Microsoft and Google and so on and so forth. You know, my focus in terms of being a financial planner is overall comprehensive financial planning as well as investment management. But my expertise and my focus is on equity compensation. I know that that's something that is extremely relevant in the tech industry. And so my firm works exclusively with those folks in that area. And so today, my presentation is going to be on just, you know, financial planning for millennials in tech. And I want this to be, you know, very conversational. I don't want this, you know, if anyone has any questions or doesn't understand anything that I'm saying, or if it goes over your head, feel free to let me know. And I'll, you know, try to hop back into the chat and see, you know, if any questions pop up. But basically today I'm just going to be talking about, again, financial planning for millennials. And so when we're talking about financial planning, right, it's really just talking about identifying your ideal life. Like, what are some of the things that you want to do, right? And so, you know, everyone, I feel like, you know, everyone wants to be wealthy. Everyone wants to build sustainable wealth, but you sort of have to, you know, yes, take some time and imagine what, on a high level, what some of the things are that you want in life, but you really have to try to pull some concrete goals out of that. And so really identify what some of those things may be. And that could be like, you know, I want to retire in the next 20 years, or I want to pay off my student loans in the next 10 years, or I want to buy a home or start a family, or, you know, take off work for 2 years and travel the world. Like, you know, really whatever it is, just do your best to identify that. Because once we can identify that very specific goal, then we can quantify it, right? And so when we're talking about, I want to buy a house, or I want to start a family, or I want to retire in the next 30 years, like, what does that number look like? What would it take for you to retire in 30 years and not have to work again? You know, like what sort of savings and investment strategy would you need to accomplish that? You know, what amount of money makes you feel comfortable enough to do that? And so just trying to, again, identifying those concrete things, quantifying them, right? Putting a dollar amount on those things, because everything we want in life is quantified. It can be determined by a specific dollar amount. And so once you have, you know, those things ironed out, essentially there is just pretty much about prioritizing your goals. And I say that because, you know, a lot of times, you know, we're very ambitious, right? There's so many things we want to accomplish. And there are plenty of times where we may not have enough resources to accomplish all of those things. And so when I say prioritize your goals, in the sense of, you know, are you willing to, you know, delay one particular goal for, you know, 3 or 4 years, then your ideal time frame to be able to accomplish this goal, which is, you know, more of a priority for you. And so essentially that could look like, you know, something like, are you, you know, willing to delay investing in your 401k and focusing on retirement to aggressively pay down debt so that when you start investing, you can sort of come out with a bang? Or what's, you know, what is the best option? Can you afford to do both? You know, both pay off your student loans and invest for your retirement, or invest for other long-term goals. And so, you know, it's really about just taking the time to sit down and, again, identifying those things, quantifying what they are, prioritizing, you know, if you had to sacrifice one over the other, you know, which is more important. And then you sort of just work your way backwards, right? Like once you have a certain sum of money that you need and you have a certain time frame, then it's about, well, if this is the amount of money I need in, let's say, 5 years, how much do I need to save every year to get to that? How much do I need to save every month? How much do I need to save every paycheck? And then you just, you know, put that thing in automation, right? And so you go in and create automatic transfers from your savings account. From your checkings account to your savings account or investment account to be able to achieve that goal, right? You're removing human error. You're removing the fact that you have to physically go in there and make a transfer and save when you just sort of automate it. And so that's usually like the number one cheat code that I advise folks to do when planning. And then it's really just building multiple streams of income. And I know that's easier said than done. I think too many people sort of focus on, budgeting. And not that budgeting is not important, but too many people focus on cutting expenses. When you live in high cost cities like New York and California and places like that, there's only but so many expenses that you can cut before you're, sort of really sacrificing on a type of lifestyle that you're living. And so, of course, it's amazing to take a look at your spending and try to course correct that and make sure that you're not overspending in any category. But I also think that it's important to try to build, as many, streams of income as possible. Having a primary role is great. And that stream of income could be, a lot of different things, depending on your skills, your talents, your knowledge, and those sorts of things. But that's essentially, the essence of financial planning. If I had to put it on a high level in terms of what are the key things that, you should be doing when thinking about financial planning, I would sort of boil it down to these three right here. And even if we're talking about like things like the pandemic, right? No one's we're in a time where you're forced to sort of take control of your finances, right? Or else there's nothing much for you to do out there. Like you're not really going out, you're not really spending, or at least as much as you would have been had there not been a pandemic. And so this is really the time, that you want to take control of your finances. No one is going to care more about your own personal finances than you. We as younger, investors, as millennials, we have so many more tools at our disposal to improve our finances than previous generations, whether it's budgeting software, automated savings platforms, credit card reward systems, blogs, old-fashioned books. Personal finance covers so many aspects of your life that it's really imperative that you spend some time putting the right financial systems in place. And another thing I would say is to, really take advantage of the markets. It's never been easier to invest in a wide range of products and securities with the push of a button. And I'm not talking about like this trendy options trading and buying individual stocks and day trading and those sorts of things. I'm really talking about, long-term sustainable wealth, having a diverse portfolio where it's aligned with your goals, where that with this investment plan, you will accomplish certain things within a definitive time frame. And then it's just really a matter of time, right? And then I think the last thing in terms of building multiple streams of income is really taking control of our human capital. We have decades to allow, compound interest to work in our favor. And, I'm not just talking about savings, right? That could be knowledge, new skills, career advancements, networking. Those can all snowball if you're willing to really put the time in. And so, when right now, this period where we may, go into another shutdown, I think those are three key things that you need to start doing. And, people say, in investing, you can choose to make investing hard, but there are so many robo-advisor solutions out there, like at Vanguard, that will put together a long-term portfolio for you. At that point, it's really just about being a disciplined saver and investor, where there's little to no work that you need to do. They'll put together a portfolio that aligns with your goals, aligns with your risk tolerance. And again, it's just pretty much a matter of being disciplined. And so, one thing that I think is that I've found to be really valuable from my clients who work in tech is sort of being able to negotiate their offers, depending on the company that you work for, depending on the stage of the company, whether it's a stage startup or a late stage startup or even a public company. The earlier stages, you sort of have more leeway, especially if you're, a higher ranking employee. But for the most part, when you're working in tech, what an employer may offer in base salary, stock compensation, bonuses, other benefits largely depend on the role that's being filled, where the company and employee is located, and there really is no one size fits all. And so, to say the least, company strategies for equity compensation can be very far from simple. And so, considering this, most tech companies offer equity as part of their compensation package. And when I say equity, I mean, if you work for Facebook, they may give you stock in Facebook, or if you work for Microsoft, you may get stock in Microsoft as part of your compensation package. But it's really important to understand that the value of that offering and how it fits into your overall financial plan. If faced with the opportunity to negotiate, a better offer, how do you decide between salary versus equity, right? The advantage of being paid in base salary is that it's a fixed amount of income, that you can expect and plan around. Alternatively, in the context of compensation and investments, equity represents ownership in that company in the form of stock. And so generally the return on that equity is often linked to company growth and performance. And the purpose of equity compensation from an employer's perspective is threefold: to attract talent, to retain talent, to align incentives, and even to reduce cash spending. Because although it's not mutually exclusive, equity compensation often does go hand in hand with a below market salary, especially a high equity compensation award. So it's really critical to know your minimum number. If you can reshuffle your priorities and costs so that your reduced salary, if you choose to, take less salary for a higher equity, if you choose for a reduced salary, you have to know that it doesn't make a significant difference in your lifestyle and ultimately your goals. And then, you've pretty much have mediated much of the pay cut. Again, it's sort of worth noting that it might be a little bit more challenging to do if depending on the company you work for or the role that you have. But, negotiating for different types of equity compensation really makes the most sense when you understand exactly what you own and the associated tax consequences, because there are different types of equity compensation plans. And so, again, in the startup world, it's not really an anomaly for companies to offer stock compensation as a method of attracting, motivating, and retaining employees. And so, from millennials in tech fortunate enough to be provided equity, the rewards can be a significant wealth building opportunity. And receiving stock options or other common types of equity compensation can a lot of the times feel like a windfall, where you're going from having your shares worth $10,000 one day, and then when everything vests or your company goes public, it's now worth $100,000 or $250,000. But the money definitely plays a significant, role in that. But I think that, real happiness and financial success really a discussion around how that equity compensation and how wealth plays a role in financial life alongside your values and your goals, right? And so this sort of financial planning is really takes a holistic approach to managing your stock compensation. And so when you receive a stock grant and acquire company stock, you gain ownership and interest in that company. Whether you participate in something called an employee stock purchase plan or have grants or RSUs, when your company stock price increases, your wealth increases, and perhaps substantially. And so if you're looking for a holistic approach to manage that stock compensation, that really is, again, the essence of financial planning, right? Identifying your goals, identifying what you want to do with the proceeds from, the stock that you received, understanding the tax consequences around receiving that stock, understanding what you want and need out of life, and really just how equity plays a role in that. So, for many millennials, that could look like starting a business or creating a nest egg for, retiring earlier than planned, or even just like providing meaningful experiences for yourself and your family. And like the list really goes on, and it really depends on you and your goals and what you want. and managing your stock compensation meshes with the many moving pieces of your financial life, right? And this can include things like cash flow needs, retirement security, income taxes, investment strategy. The list really goes on. And so again, like these are three of the most common types of equity compensation plans that I've seen. And it's really critical to know what you own because, for example, employee stock options give you the option to buy company shares at pretty much a discount, right? At a very a low discount. And RSUs pretty much involve a direct transfer of shares to grant recipients. And what I mean by that is this: if I have stock options, and let's say I work at Airbnb, when I first started working at Airbnb, I could have gotten shares for, maybe 50 cents or even $1. And now that Airbnb went public, if you take a look at it now, I think their shares are selling for about like $150. And so that gap is that gain that I could have taken advantage of if I owned stock options in Airbnb as an employee, particularly as an early employee. RSUs function a little differently. And again, like there's so many different nuances with the different types of equity compensation that you could be granted. Like it's really important to understand the different intricacies so you can be able to, properly take advantage of them. Equity compensation can get really technical, and it, really depends on, your exact situation and what your goals are. And so I don't want to dive too much into the technicals. If anyone has any questions about equity compensation or anything like that, you guys, I guess we can stop it right now and we can have Q&A. And if there's any, thing that I mentioned that you wanted to, me to elaborate on further, or if there's any questions that you guys had about just financial planning in general, I'm, more than willing to take, the next, I guess we have 30 minutes left because it's supposed to go to 2 o'clock, just, answering your questions and being able to chat and, help you guys as much as I can. So if you have any questions, feel free to drop them in the chat and we can go from there. Yeah, I think I'm not from. I think the name is Hollingway. Hollingsway has a pretty good. Hold on one second. Let me actually look it up. I'm not sure if that's the exact name, but I think it's called Hollingsway. Yes, the Holloway Guide to Equity Compensation. You can Google that. Actually, I'll type it in the chat box right now. If you go type that into Google, they have a pretty extensive library of equity compensation material as a founder as well as an employee. Again, a lot of the equity comp stuff is general because, it really depends on your company. Like firms have the option to sort of manipulate their equity compensation plan however best they see fit. And so a lot of the information you'll find will more than likely be related to the infrastructure of the plan and essentially the tax consequences. And those are all general things. It really depends on your situation. But the Holloway Guide, I would say, is probably one of the best resources out there when it pertains to equity compensation. All right, Jasmine, any tips for negotiating equity stock when joining a startup? Yeah, so I think if you're joining a startup, one of the things that I like to encourage folks to get is something called acceleration rights, where, and again, it really depends on the position that you have, but acceleration rights essentially, when a company grants you equity, you don't usually get all of that equity at once. Essentially, over the course of time, or it may be time-based or performance-based. Let's say it's time-based, for example, over 4 years incrementally, that equity will then belong to you. So let's say they'll give you a thousand shares of their company. You may get 250 shares each year. And at the end of 4 years, of working there, you would have had those 1,000 shares. But there are times where, let's say year 2, that company gets bought or merges with another company. What happens to the shares that you've owned so far, the 500 shares that you've owned, those belong to you. But what happens to the other 500 shares that were promised to you that you don't own as yet? And so a lot of times, that can go away, especially if you're terminated. And so what I like to encourage folks is to get is acceleration rights, and there's different triggers. And so a single trigger acceleration right means, if my company gets acquired or merges, all of the shares that belong to me, that all of the shares that were promised to me that but don't yet belong to me, belongs to me immediately at the acquisition or merger. A double trigger acceleration means that two things need to happen. Number one, the company needs to get acquired, and number two, you need to get terminated for all of those shares that were promised to you to be granted to you. And so a lot of times those are sort of reserved for C-suite or executive level positions. Something I've seen that's pretty common for, I guess, entry level and mid-level positions are something called refresher grants, where your company may give you an initial grant in the beginning of your employment, and after 4 years, that equity that they promised you now all belongs to you. So theoretically, now that you have this equity, you could choose to leave and go to another startup and get more equity there. So what a company may do is they may say, hey, we love you, you're great talent, we want to keep you, we want to give you a new grant that's going to, that you'll get over the course of another 4 years. And that's what's called a refresher grant. It's basically their way to incentivize you to stay by giving you additional shares. And so if you're negotiating with a company, that's something that I've seen that's pretty popular, where you can negotiate for more shares once the original shares that they offered you belongs to you after that initial time period. So I hope that helps, Jasmine. Let's see. The Dow, Glenn says the Dow is at an all-time high. Should we be wary to invest now? I think this question largely depends on your investment philosophy. And so if you have a long time frame, let's say you have personally, you shouldn't be investing any money that you'll need within 3 years. If you need this money within 3 years, you should just be aggressively saving it in a savings account. I would even say 3 to 5 years. Anything beyond that, definitely you can invest, but we don't know what the stock market is going to do in the next 3 to 5 years, to be frank with you. Anyone that tells you they know is probably lying, or they don't know what they don't know. But 3 to 5 years is 3 years definitely is really too short of a time frame for you to need money for it to be invested. And so if your time horizon is 5, 7, 10 years and beyond, it doesn't really matter what the Dow is doing right now, because you don't need the money right now. When you should be conservative is when you're getting closer to the point where you need those funds. And so if that time is far away, you can afford to be aggressive as much as you want. And that's sort of the principles of investing, right? When you invest for your goals, you're investing to understand, when do I need this money by? What am I investing this money for? And when you approach investing with that framework, it sort of allows you to make logical decisions rather than emotional decisions. So I hope that answers your question, Glenn. What is the biggest barrier to financial planning, wealth building you see in millennials? That's a good question. The biggest barrier. I think the biggest barrier I see is sort of FOMO. Like a lot of people making financial decisions and investment decisions because people are talking about it or it seems cool. And I'm trying to find the best way to put this, but there are so many ways to invest other than buying individual stocks. Stocks are most, one of the more riskier investment strategies that you can take, that you can have. Warren Buffett says it even best. Like, the average investor is better off investing in the S&P 500 index, which is essentially 500 companies in America. Those 500 companies essentially determine the majority of the movement of the United States stock market. And so when you're investing, because you can invest in the S&P 500 index and get market-like returns, because those 500 companies sort of represent the market, if you're not beating or getting more performance than the S&P 500 index, then you might as well just invest in the S&P 500 index. And so 3 out of 10 financial professionals beat the market year after year. And so I think the biggest barrier that I see in millennials is that we get caught up in, and I think it's great that we have all this information available to us, but I think that there are a lot of folks that aren't necessarily taking the baby steps in terms of learning the basic fundamentals of investing, and they're jumping right into investing in individual stocks. I think there's nothing wrong with investing in individual stocks, but that should represent, a small portion of your net worth, as opposed to investing, sustainable wealth, right? Using index funds, using a diverse portfolio where there's little to no work that you will have to do as an investor, because you're invested in the market. And over the past 25 years, the market has only been in an uptrend, if you look at it in a 25-year time frame. And so just by investing in the market and not trying to beat the market, you're able to accomplish long-term goals, and as long as you're, disciplined, you're saving, you're investing. And so, I think there's just some misconception behind, you having to be trading or buying individual stocks and watching the stock market every day in order to build wealth. And so I think that that's a pretty big barrier. It's just the financial media aspect. Like, financial media is still media, and their goal is to get you to do the clicks, is to get you to do the things that attract attention. And successful investing is boring. Like, I'll tell you that right now. Like, and again, Warren Buffett quote, successful investing is like watching paint dry on a wall, or like watching grass grow. That's when you're doing it right and you're doing it prudently. But media they can't make money off of that, right? And so they have to sell you the hot stock and all the, so I think that just being aware of those things, at least from my experience, has been a barrier for a lot of the folks that we consider our peers. How do you feel about investing in cryptocurrency? I personally don't view cryptocurrency as an investment vehicle. I rather view it more as a currency. I think there's so much legislation around it that for cryptocurrency on the high level, for cryptocurrency to be, an investment vehicle, it will have to be globally accepted. So until it's hard for me to see that as a possibility, or at least a sustainable possibility. But I have more hopes for cryptocurrency as actual currency, like being able to go to the store and pay for something in cryptocurrency, as opposed to it being an investment vehicle. Which podcasts, blogs, conferences, LinkedIn groups, or books do you recommend? So a lot of, I can start with well, blogs, I'll say mine. So I have a newsletter. I only work with tech folks, and so my newsletter and my blogs and the content of the stuff that I speak about is largely associated with equity compensation and just how to fit that into your financial plan and just overall financial planning. And so if you're curious to see, what financial planning is like, a couple of receiving a couple of issues of my newsletter and a couple of blogs, I think will sort of paint a good picture. You can go to deanefinancial.com or techmoney.deanefinancial.com, and you'll be able to get access to both the blog and the newsletter. But aside from that shameless plug, in terms of books, I would say the number one book I usually recommend to folks is I Will Teach You to Be Rich by Ramit Sethi, I believe is how to pronounce his last name. That is the number one book for me. That's a book that I give to clients. I think it does the DIY investor very well. Yes, that's how you spell his name. I think it does the DIY investor very well. Those who, like to do things themselves or feel like they may not be ready for a financial advisor, that book sort of tells it out, spells it out plain and simple of the different things that you can do and that you can take advantage of. Conferences, I think just, reading that book and maybe that book, The Intelligent Investor, depending on your level of, investment knowledge. The Behavioral Investor by Daniel Crosby is also a great book. It really just, again, taps into understanding your money story and your relationship with money and how that plays a role in your finances today. And in terms of building sustainable wealth, I would say Simple Wealth, Inevitable Wealth by Nick Murray. That book is geared more so towards financial advisors, but it really just talks about, again, the need of not having to take the risks of investing in individual investments, or at least not having the majority of your net worth in individual stocks and having them in things like mutual funds and ETFs that still give you exposure to those individual stocks, but they're not as risky. They're more diverse. And if you don't know what an ETF or mutual fund is, like if you go on NerdWallet, they sort of break that stuff down pretty easily as well. Out of the recent tech IPOs, is there one you would suggest researching more on from an investment perspective? So IPOs are usually not the best investment to make on the day that they IPO. There are very few IPOs that have gone up and only up from their IPO price. The real winners of IPOs are folks who are on the inside, founders, employees, and other shareholders. Again, to be able to shares for literally pennies on the dollar to then sell it for hundreds of dollars after the fact is a pretty incredible opportunity. But for folks like us who don't have access to IPO prices and we have to wait until the shares hit the secondary market. And so for folks who aren't aware, where we trade, the everyday investor trades is the secondary market. And so an IPO is essentially when the company sells their shares to a company like Morgan Stanley for a particular price known as the IPO price. Morgan Stanley then sells those shares to us in the secondary market for whatever we as the public market determine that stock to be worth. And so a lot of the times you'll have private companies that have the hype like we work, and when they file to go public and then their private documents are now being able to be viewed by public investors and they're now scrutinized, you are really able to see that company's financials. And so most of the time when a company goes IPO, it's usually because they need more money. It's like a fundraising event for them. Them entering the public market and us investing in their shares are essentially like a fundraiser. And so a lot of the companies that go public initially are not profitable, especially as of recent, right? These tech unicorns that you see are not profitable, but we're evaluating them at very high prices based off of non-traditional fundamentals like disruption potential rather than profitability. And so usually when, a company goes public, you can usually, because they have to report now to the public markets, and analysts and Wall Street is now, valuing these companies. A lot of times what happens is their price dips lower than their initial price that they went public with over the next 6 to 12 months. And so I don't usually invest on IPOs like the first day they go public. I usually keep my eye on it for 6 to 12 months if I feel like it's a good company, and try to get in at a price that I think is worth it. I will say, and this is not investment advice, I will say the one company I think about all the time that I didn't invest in is Shopify, where they went public, I think, at like $19 and has been going up since. And now I think they're selling for like over $1,000 a share. So that's something that I personally, because of my philosophy, I missed out on. But I would hate to pay, $150 for a stock, and then 12 months down the line, when the performance and the financials are not public, they're worth like $30. And, now I'm hoping on disruption potential because profitability is not there. And so, that's sort of how I feel about IPOs. Two that I am excited about upcoming are Stripe and Roblox, just because of moves that I've seen them make. I'm not sure if I would invest in them at the IPO, but those are two companies that have IPO plans that I sort of like their business model and what they do. Am I familiar with the FIRE movement? So I see this last question. The last book is called Simple Wealth, Inevitable Wealth by Nick Murray. And so, yes, I am familiar with the FIRE movement. My thoughts on that, if that's something that you want to do, then, by all means, I think no one should determine how you want to retire. And if retiring early is something that you want to do, you just have to make sure that you're really willing to make the sacrifice to do so. And making sure you really understand how much you really need to retire early. And, identifying, well, what does retirement look like for you? Does it look like retiring at 40 and never earning a single dollar again actively, and you're only depending on your investments for income? Does it look like you working on your own time? Does it look like you working part-time, doing contract work, freelancing every now and then? Are you planning on buying property and then having the rental income pay your bills? Like, there are many different ways, or I guess visions or ideas of retirement these days. And so it's good to identify, well, what does retirement look and feel like for you, before you can even, sort of plan an early retirement. But I don't have anything against the FIRE movement, as long as you're willing to make those sacrifices and you're confident that if you don't plan on working or earning income actively, that you have enough of a nest egg and investments to be able to provide income for, whenever you retire until, yeah. All right, that looks like the last of the questions. I don't think I missed any. But I hope you guys enjoyed the presentation. I hope you were able to take away a few things from it. And if you have any questions, my social media is Samuel S. Deane on all platforms. So you can feel free to shoot me a message or shoot me a DM, and I'll try to help out as best as I can.